Hi, my name's Eric. I'll be reading you selections from Barron's magazine, dated today, May 18th of 2026. We'll start with Up and Down Wall Street. This reading is produced by the Audible Local Ledger, a reading service expressly for people who are blind or print disabled. Microsoft goes beast mode on AI. Hedge funds take sides. The facial expression in question belongs to Microsoft CEO Satya Nadella this past week in an Oakland, California courthouse as he took the stand in Elon Musk's lawsuit against OpenAI. Nadella's discomfort is understandable. Here we have the usually sweater-clad executive in a suit and tie, testifying under oath about his private correspondences in a multi-trillion-dollar trial where he's locking horns with the richest man in the world. No doubt Nadella would rather have been at the dentist, and yet fighting this fight is very much part of his remit, particularly since, as of October, Nadella turned over the keys of the commercial side of Microsoft, which accounts for more than 70% of its revenue, to Judson Althoff, putting him in charge of the most important part of the company. I am focused on Horizon 0 and Horizon 1, Althoff told me in high Microsoft speak. Satya tends to focus on Horizon 2 and Horizon 3. Translation: Judson's running the current business, Satya is going to figure this artificial intelligence thing out. The two endeavors are inextricably linked, as Microsoft hopes that business customers increasingly will adopt its Microsoft 365 Copilot AI product and other AI offerings. In other words, selling AI is very much a here and now matter for Microsoft. Even though Microsoft says that Nadella will be laser-focused on our highest ambition technical work, the CEO must also wrestle with massive strategic issues, like Microsoft's relationship with OpenAI and its ChatGPT large language model, the brains of its AI endeavors. Microsoft has invested nearly $12 billion in OpenAI over the past 7 years, and now has a 27% stake in that company worth a staggering $230 billion. Musk's lawsuit is an existential threat to that relationship as he seeks to wind OpenAI back to its 2015 nonprofit roots, as well as undo its special relationship with Microsoft. Microsoft also has a partnership with OpenAI rival Anthropic. And yet there may be even more to Nadella's pained look than just battling Musk, that being Microsoft's stock performance, which over the past year has declined by 9.6% versus gains of 138.1% for Alphabet and 27.3% for the S&P 500 index. Of course, Microsoft shares over Nadella's tenure, which began February 4th of 2014, have been like a SpaceX rocket, up 1,025% versus 322% for the market. Nadella's predecessor as CEO, Steve Ballmer, once told me, "I love Satya. I haven't sold my stock." Ballmer reportedly owns some 300 million shares, now worth $130 billion. They were valued at just under $12 billion when Nadella took over as CEO. Microsoft's recent quarterly numbers were up briskly almost across the board. The company reported adjusted earnings of $4.27 a share on revenue of $82.9 billion for its fiscal third quarter, while analysts expect $4.05 a share on revenue of $81.4 billion. Its Azure cloud business grew a stellar 40%. On Friday, the ever-voluble hedge fund manager Bill Ackman disclosed in an 887-word tweet that he had recently acquired a position in Microsoft as a core holding. Still, AI fears are making the Beast of Redmond, as Microsoft is sometimes called, look a little less fearsome. The Financial Times reported that Chris Hohn, the highly regarded manager of TCI Fund Management, sold most of its $8 billion stake in Microsoft, which it's held for the past 10 years. TCI, the most profitable hedge fund in the world last year with a sterling long-term record, noted in its letter to shareholders, "We reduced our investment in Microsoft because the rapid progress in AI introduces uncertainty over Microsoft's competitive position in the future. It'll be great fun to see who's right here, Hone or Ackman. Another risk to Microsoft posed by AI is prodigious capital spending on chips to run AI, data centers, and electric power generation. CapEx has climbed from $24 billion in fiscal year 2021 to $88 billion in fiscal year 2025. The $190 billion projected this year is based on MSFT's 2026 calendar year. That multi-hundred billion dollar spend, plus Hone's concerns about AI making Microsoft's legacy business obsolete, and questions about AI adoption by Microsoft's customers are making Wall Street nervous and raising questions that Althoff, in his increasingly public-facing role, wants to address. Note that Althoff, who's 53, may one day be in line to become CEO of Microsoft, though that would be years off, as Nadella, who's 58, isn't likely to be going anywhere anytime soon. So, what does Althoff think about these AI worries? Well, they don't concern me because I think the market's still trying to figure out AI, he says. When customers or analysts start thinking, gosh, AI is going to eat software, or SaaS, it comes from the place of seeing parlor tricks. It's very easy to ask a model to create a document or spreadsheet. It is materially more difficult to say, take this presentation for a meeting with my board, update this data on our financial performance, and give me the 6 trailing quarter view of a certain business and have it be in context, accurate, and pulling from secure sources. As for the capital being spent, Althoff is equally sanguine. Yes, it's expensive, he says. I don't get concerned. We're building for our first-party AI solutions and infrastructure for Anthropic, and for a future where the combination of human ambition and AI will come together to run the world's business processes. Microsoft says it has 20 million customers paying seats for its premium AI Copilot product, out of a total of some 450 million business seats. Tigris Financial Partners, which has a buy rating on the stock and a price target of $680, the stock currently trades at $407, notes that adoption is scaling rapidly, with paid Copilot seats growing triple digits year over year to tens of millions of users. But what are customers actually doing with Microsoft's AI products? Raj Sharma, Global Managing Partner for Growth and Innovation at EY, has rolled out an agentic AI platform called EY Canvas to facilitate the company's core global audit business based on Microsoft AI products. If I looked at all the technology stack and the capital spend that's required, only 3 companies stood out to me for an enterprise of our size: Microsoft, Google, and AWS, says Sharma. We picked Microsoft because of our long-standing relationship, and they'll give us access to any models, whether it's OpenAI or Anthropic. Also, there was a level of trust with them that they'll co-innovate with us. Rob Goldstein, COO of BlackRock, says his company worked with Microsoft and its AI tools to translate BlackRock's websites into local languages around the world. These are highly regulated websites that need to have all sorts of information about the company and the products we provide, he says. We feel very good about our relationship with Microsoft, but he adds, this will not be a one-vendor game. All hasn't been smooth sailing in Microsoft's AI efforts. The Wall Street Journal reported that customers have been confused by various Microsoft AI brands and products, and that some have preferred using Google's Gemini and other options. The company has changed up leadership in its AI teams, perhaps to address these issues. To long-standing Microsoft watchers, as my colleague Adam Levine noted in a recent Barron's cover story, the choppy start may be chapter 1 of a familiar narrative. Microsoft typically isn't first, but the company's vast installed base means it can switch into beast mode and win in the end. That last point almost makes Althoff cringe. We take nothing for granted, he says. While I am proud of our base and grateful to our customers for trusting Microsoft, I want to make sure that we continue to build the best AI capability. I always say to my folks, neither winning or losing are statements of perpetuity. The bottom line is that companies want to know if shelling out big bucks today for AI tools from Microsoft or its competitors is truly worth it. Right now, the jury may still be out. In a new white paper, LLMs corrupt your documents when you delegate, researchers concluded that for longer tasks, current LLMs are unreliable delegates. They introduce sparse but severe errors that silently corrupt documents, compounding over long interaction. The three authors of the paper are from Microsoft Research. For investors with insomnia, NASDAQ FCEO Adina Friedman has just the tonic, and it's right around the corner. 23-hour-a-day trading, still only 5 days a week, though. I asked her why this was necessary. Technology has really continued to advance to allow for investors from all over the world to be able to trade in U.S. equities anytime during the day, she says. Trading 23/5 is already happening. It's just happening in the dark. Our systems today open at 4 a.m., and we allow trading to start then, and they close at 8 p.m. So we're already trading outside of U.S. market hours. What we're doing is basically expanding that. Traditional U.S. stock exchanges are open only from 9:30 a.m. to 4 p.m. Eastern Time, but extended trading has been growing. Some institutions and individuals trade in lower liquidity after-hour sessions. Some broker-dealers offer extended trading for certain stocks, and there are also derivatives that can mimic after-hours trading. Crypto and currencies trade 24/7. Friedman notes that NASDAQ is partnering to facilitate longer hours. We've worked with the industry to bring the consolidated tape and have that launch at the same time, which is December 6th, she says. You'll have central transparency of all trading and quoting activity in the lit venues and dark pools around the world. The exchange plans to add circuit breakers to halt trading if prices go up or down too much, so we have more trading guardrails. Friedman notes that the depository Trust and Clearing Corp. is extending its hours so there'll be real-time clearing. There are millions of investors who want to access the U.S. economy and trade amazing companies, and this will give them a good infrastructure to be able to do that, Friedman says. We feel that it will increase overall demand and increase the pie. A lot of clients are looking at how to support 23/5 trading, and we can provide technology to support them. That piece was written by Andy Serwer. Moving on, in the Barrons of May 18th of 2026, the Streetwise column, which is written by Jack Huff. The equity risk premium and other mythical beasts. There are certain things that friends should never say to each other, and I'm pretty sure equity risk premium is one of them. So, when a fellow 401k squirreler confided that his stash is looking pleasingly fat, but is now overloaded in stocks, and that he'd like to move a chunk into something safe, paying 4 to 5% a year, I kept my response business casual. Makes sense, moneybags. I didn't mention that he had brushed up against a cornerstone of modern finance, the equity risk premium, brought up to me earlier in the week as something of a warning by a chief investment officer overseeing $29 billion. Let me break it down here, partly to touch on where things stand for stock investors, and partly so that those unfamiliar with the concept will know what it means and doesn't mean if they encounter it in the wild. Start with Goonies. Yes, the 1985 Steven Spielberg adventure, early in which Mikey from his porch opens the front gate for Chunk using a device that employs a bowling ball, bucket, balloon, a chicken, football, and sprinkler. This, of course, is an example of a Rube Goldberg machine, an overly complex mechanism that performs a very simple task. The equity risk premium is a lot like the Goonies gate opener, only maybe not as reliable. Mathematically, it's often written like this: ERP equals ERM minus RF, which means that the equity risk premium is equal to the expected return of the market minus a risk-free rate. If you expect the stock market to return, say, 10% a year, And if you can instead buy something that pays a guaranteed 4%, then your compensation for dealing with the chaos of the stock market, that's the ERP, is 6%. There's just one problem. You can't bake a certainty pie if your ingredients include, berries. We can't truly know the ERP unless we know what the market will return. And if we knew that, we wouldn't have to fiddle with theoreticals about whether we're being compensated enough. Think of the ERP as merely a loose framework for judging the relative appeal of stocks versus safe bonds. If you wish to use the ERP to tell whether the stock market's a good deal, you'll have to do the best you can with expected market returns. One option is to use historical average returns, but that says nothing about whether stocks are expensive or cheap now. Another is to take a survey, but that just outsources the guessing. The Federal Reserve uses a method that at least benefits from clarity and consistency. Twice a year, each May and November, the Fed publishes a financial stability report that sizes up risks to the financial system. It includes a chart of the ERP. To calculate it the Fed way, take the stock market's forward earnings yield and subtract the real, or after inflation, 10-year Treasury yield. Earnings yield is just a year's worth of estimated earnings divided by the market's price level. An upside-down price-to-earnings ratio, in other words, expressed as a percentage. I recently got 4.7% for the S&P 500 index. For the real Treasury yield, you can just use the 10-year Treasury inflation-protected security yield, recently close to 2%. Putting it all together, the market's 4.7% earnings yield minus the 2% real risk-free rate gives an ERP of 2.7%. We're still baking with berries because the market's earnings yield is by no means a slam-dunk predictor of future returns. The actual number you get isn't what matters most. Since the approach is consistent over time, you can compare the current number with its history. This being May, we just got a fresh financial stability report, and in it, the Fed notes that the ERP has moved up a touch but remains near a 20-year low. Remember, the ERP represents a return an investor is getting, not a price he or she is paying. So, unlike with the P to E ratio, higher in this case is good, and low is potentially worrisome. The median ERP in Fed data since 1991 is 4.6%. The low during the dot-com stock bubble was negative. Stocks could easily push well higher now, especially because of explosive earnings growth from artificial intelligence spending. That's what's made the ERP a touch more attractive since November. Some people argue that the ERP was too high to begin with, and it's naturally moving lower over decades as investors view the market as more dependable. I've called it buy the dipitis, but could it instead be falling risk? I actually believe that what we're seeing is more about incredible euphoria or optimism than it is the extinction of the risk premium, says Brad Conger, Chief Investment Officer of Hurdle & Company, an independent investment office for institutions and wealthy families. People can be so excited about growth that they make bad assumptions. Conger sees a risk that big AI spenders learn to do more with less, and growth slows, or that some of the build-out proves excessive, like fiber optic cable that was laid too soon in the 1990s. That's what really kills an economy, when you're malinvested $1 trillion and somebody here, being the debt holders, has to eat it, he says. He recommends trimming tech holdings, rebalancing portfolios with more bonds, and adding exposure to Europe, not fleeing U.S. stocks altogether. And there you have it. If against all odds you have found the ERP fascinating, I recommend looking into something called the capital asset pricing model. It's a machine that can tell what a stock will return, only please don't use it for that, because it relies on the same berries as the ERP, plus some unicorn dust in the form of risk conjecture. In Goonies terms, that gate opener is so complicated that Chunk would still be waiting to get in. Moving on in Barron's, a little bit about what happened last week and a little bit about what might happen this week from the review and preview section. It starts with playing a hot Korea. Korean stocks have soared nearly 80% this year, making them the world's best performing market. But hedge fund managers at the Seoul Investment Conference this past week still saw bargains in an often overlooked market that's bigger than Canada's, with gross domestic product per capita on par with Japan. As PLP Funds founder and chief investment officer Jonathan Lennon said, "The world is coming to Korea as a leader in chips, ships, and defense." Korean outperformance has been fueled by its chip-making duo of SK Hynix and Samsung Electronics, and from government efforts to improve governance and capital allocation. Portento Partners founder Eduardo Marquez sees a backdoor entry through Korea's conglomerate holding companies. Take memory chip maker SK Hynix. It trades at 6 times forward earnings, cheaper than Micron Technology at 10, and it should remain a cash gusher as artificial intelligence booms. The backdoor play? Buy SK Hynix parent SK Square, which trades at a 47% discount to the chip maker. Another holding company, Samsung Life Insurance, trades at 50% of book value and holds a 10% stake in Samsung Electronics. Meanwhile, SK Hynix redistributes 10% of its operating profit in employee bonuses, a practice Samsung is starting to adopt. That's as much as $37 billion in bonuses, a mid-single-digit share of GDP, and a boon to other Korean companies. That was written by Reshma Kapadia. Last week in the markets, President Trump called Iran's peace proposal unacceptable before heading off with a retinue of U.S. CEOs to Beijing for talks with China's Xi Jinping. Oil rose. U.S. stocks edged to new highs on Monday. April data were grim. Energy prices drove inflation to 3.8%. Producer prices came in at 6%, the most in 4 years. The Senate confirmed Kevin Warsh to chair the Federal Reserve. The Nasdaq Composite hit more highs as chips soared. In Beijing, Xi warned Trump about Taiwan, but there were no big breakthroughs. Stocks were down on inflation worries. On the week, the Dow Industrials fell 0.2%. The S&P 500 rose 0.1%, and the Nasdaq shed 0.1%. In companies last week, China ordered 200 Boeing planes, fewer than expected. Blackstone asked senior executives of its flagship private credit fund to back the fund as redemptions rose. KKR's biggest private credit fund took what amounts to a 10% write-down of its net asset value. Walmart is laying off or relocating 1,000 corporate workers. Trump announced that Food and Drug Administration Chief Marty Makary was exiting the agency. In deals last week, the Wall Street Journal reported that Apollo Global Management held talks to sell one of its private credit-focused business development companies, Midcap Financial Investment. eBay rejected GameStop's $56 billion unsolicited bid. OpenAI-backed chipmaker Cerebras Systems went public, raising $5.55 billion, the largest this year, and shares rose 68% on the debut. This week, on Tuesday, May 19th, 17 S&P 500 index companies announced quarterly results this week as first quarter earnings season winds down. Home Depot reports results on Tuesday, followed by Intuit, Lowe's, Nvidia, and Target on Wednesday. Deere and Walmart release their earnings on Thursday. On Wednesday, May 20th, the Federal Open Market Committee releases the minutes from its late April monetary policy meeting. At that confab, the FOMC left the federal funds rate unchanged at 3.5 to 3.75%. It was the last meeting for Jerome Powell as Fed chair, who led the central bank for over 8 years. Powell's successor, Kevin Warsh, was confirmed by the Senate this past week. On Thursday, May 21st, the Census Bureau reports residential construction data for April. Consensus estimate is for a seasonally adjusted annual rate of 1.41 million privately owned housing starts, roughly 90,000 fewer than in March. S&P Global releases both its manufacturing and services purchasing managers indexes for May. Economists forecast a 53.7 reading for the manufacturing PMI and 51.1 for the services PMI. And this compares with readings of 54.5 and 51, respectively, in April. By the numbers, 73%. That's the percentage of Americans in a Fed survey who say they're doing okay financially, holding steady since 2022. 40. That's the average age of U.S. student loan defaulters, almost 2.5 years older than defaulters before the pandemic. 4 million is how many barrels of oil a day in global reserves fell on average in April as a result of the Iran war, a record high. And 5.13%. That's the yield on 30-year U.S. government debt sold this past week. It's the highest since 2007. The next article in Barron's of May 18th, 6 stocks to play quantum fever. Quantum technology holds out the promise of transforming computing by producing enormous gains in processing power. But it's a technology under development with no real certainties about the future. Here are some contenders for quantum supremacy. By Mackenzie Tatanani. Quantum computing has graduated from a theoretical curiosity to a stock market phenomenon. The sector's shares routinely post some of the biggest market moves, up and down, as investors place bets on the future of computing. Quantum computers, offshoots of quantum mechanics, can explore multiple solutions at once and promise the kind of processing power that could revolutionize medicine, materials science, and other fields. The technology is unquestionably tricky for investors. The pure play stocks, the shares of companies that concentrate their efforts wholly on quantum computing, trade mostly on sentiment, since none of the companies have yet to turn a profit. Most are burning cash as they develop products. The performance of the stocks has been all over the map. D-Wave Quantum last year more than tripled, and Rigetti Computing rose 45%, handily outstripping a 20% gain for the tech-heavy NASDAQ 100. IonQ rose just 7.4%, while quantum computing lost 38%. Such varied outcomes suggest that idiosyncratic stories, rather than industry tides, are dictating the winners and losers. Valuations tell a tale of two worlds. IBM, a tech mainstay with a robust quantum effort, is trading at a measured 2.9 times forward sales. Hype has pushed Rigetti Computing and D-Wave to price-to-sales ratios of 746 and 268, respectively. Numbers like that aren't for the faint of heart. But by many accounts, the industry is about to take off. Barclays anticipates that quantum systems will achieve a definitive edge over traditional computers by 2027, provided their capabilities hold up under intense technical scrutiny. Estimates from McKinsey project that the market will grow to anywhere from $43 billion to $72 billion by 2035. As the future of quantum computing starts to take shape, there are plenty of ways to play it. Here are 6 stocks worth considering. IonQ. This is the largest publicly traded quantum pure play by market cap, and one of the boldest. CEO Nicola de Masi referred to the company as the NVIDIA player of quantum. Last year, IonQ became the first quantum company to surpass $100 million in annual revenue under generally accepted accounting principles. First quarter earnings further demonstrated its growth, as IonQ reported a narrower than expected loss and a spike in contracted backlog, a sign of accelerating demand. Next is D-Wave Quantum. The company has cornered the market for annealing quantum. That's an approach tailored to optimization tasks. However, D-Wave is targeting the launch of a superconducting gate model system this year. This versatile approach uses ultra-cold circuits to store data and microwave pulses to perform calculations. Revenue fell 81% in the first quarter due to a system sale in 2025, but Jefferies' Kevin Carrigan noted that the underlying momentum remains. D-Wave posted record bookings and increased its system sales. Rigetti Computing. After a months-long delay, Rigetti released its largest quantum system to date in April. The company is taking time to refine its technology before scaling to bigger systems, which has led to several timeline revisions. To reduce its dependency on research and development contracts from U.S. government agencies, Rigetti is prioritizing sales of its machines. The company sold a 9-qubit Novera processor to a Canadian university in March, just months after an $8.4 million sale to a research institution in India. Quantum computing. The company is no stranger to uncertainty, given the months it spent searching for a permanent CEO before promoting Yuping Wang in January, and scrutiny from short sellers claiming it fabricated revenue and misled investors about its chip foundry. The company hasn't acknowledged those claims. Despite mixed results, shares rose 16% after first quarter earnings. Quantum has signaled its intention to scale up in communications and photonics. Xanadu Quantum Technologies is number 5. Soon after its U.S. debut, Xanadu stock cratered after the company filed to allow shareholders to register shares for sale. The sell-off reflected anxiety over increased shares. Xanadu is betting on photonic quantum computing, which uses light to carry and process information and can operate at room temperature. Revenue was up fourfold in the latest quarter, with Xanadu citing continued adoption of its software platform, Penny Lane. And finally, IBM. Big Blue, a cornerstone of the quantum ecosystem, offers cloud-based access to its quantum fleet and maintains QuizKit, an open-source development kit enabling users to build quantum programs. Morgan Stanley's Eric Woodring says the market's likely discounting or underwriting some degree of quantum in the stock price. While IBM's scale and diversification usually cut volatility, shares popped when it unveiled its roadmap to achieve fault-tolerant quantum supercomputing by 2029. The next article, Why NVIDIA Stock Could Still Rise Another 50%, by Al Rote. The AI chip titan is projected to earn a record of $190 billion in 2026, even though its stock trails its semiconductor rivals. Yes, a $5 trillion company trading at an all-time high can be cheap. It's an opportunity for investors to earn 50%, while the company's market capitalization marches toward $8 trillion. This, of course, is about NVIDIA, the artificial intelligence chip giant that's transformed the stock market and may be on its way to transforming the entire U.S. economy. As NVIDIA prepares to report earnings after the close on May 20th, the company's on the cusp of earning more than $190 billion in calendar year 2026. That would be the best year for any corporation ever, according to Dow Jones market data. Saudi Aramco, which earned about $160 billion in 2022, holds the current record. Against that setup, how could NVIDIA be cheap? For that matter, how could things get even better for the maker of graphics processing units? Well, for starters, the stock trades for about 24 times earnings expected over the coming 12 months, a 25% discount to its historical value, and 5% below the PHLX Semiconductor Index, which includes Advanced Micro Devices, Micron Technology, Taiwan Semiconductor Manufacturing, Intel, and others. NVIDIA, as a fast-growing leader, typically trades at a 40% premium to the index. Since the start of 2025, NVIDIA has trailed the index by more than 70 percentage points. 70! The market has suddenly forgotten about NVIDIA while going gaga over CPUs, central processing units, memory, and application-specific chips such as Alphabet's Tensor processing units. But if demand for semiconductors has exploded, as the earnings and stock performance of countless semiconductor companies imply, is NVIDIA stock really going to be left in the dust? No. And the thesis for buying NVIDIA here is quite simple. Investors really need to believe just one thing. This isn't yet as good as it gets for AI computing. And there are several reasons to believe just that. For starters, look at the earnings report of countless companies in the semiconductor value chain. We're still in the early days of the AI infrastructure growth. John Kemp, CEO of semiconductor materials supplier Quinity Electronics, tells Barron's, "Wherever people are located, the proliferation of AI beyond data centers into every other part of the industrial economy is one of the things that gives us confidence in the durability of the growth cycle." Strange as it may sound, AI applications still haven't achieved widespread use. Just 20% of smartphone users have used an AI agent application on their phones, according to ARK Investment Management's chief futurist, Brett Winton. That number will be approaching 100% in 3 years. That makes 2026 more like 1996 rather than 1999. If investors are thinking about dot-com era comparisons. AI is still an accelerating arms race. The 4 hyperscalers, Amazon, Alphabet, Meta, and Microsoft, are now expected to spend almost $700 billion building out their AI businesses in 2026. At the start of the year, that number was closer to $500 billion. Looking into 2027, Melius analyst Ben Reitzes expects capital expenditure, including that from the likes of Oracle, to top $1 trillion. The spending spree is on. How tech giants can afford this is a valid question. The answer? Easily, by deploying substantial portions of their operating cash flow into data centers, but not at the expense of positive free cash flow this year. The Big Four are expected to generate earnings before interest, taxes, depreciation, and amortization, or EBITDA, of roughly $800 billion. Their balance sheets are also pristine, with essentially no net debt among them. As for where NVIDIA shares can go, investors can just look at Wall Street's estimates. The average analyst price target is $270. That's up 20% from recent levels. That works out to 24 times estimated fiscal year 2028 earnings, which are expected to expand 35% compared with fiscal 2027. NVIDIA's year ends in January, so fiscal 2028 is essentially calendar year 2027. That target is conservative. If NVIDIA were just to trade in line with the 26 average multiple of the other semiconductor stocks, it would be a $290 stock. Its historical premium to the semiconductor sector justifies a $390 stock price. The midpoint of those numbers, $340, would represent a 50% gain. To be sure, there are risks. For one, bubble fears persist. Searches for AI bubble on Google are up 400% year over year, having peaked in November. NVIDIA's earnings outlook doesn't leave much room for error either. It will have to beat analyst sales growth estimates of almost 80% to satisfy investors. A miss isn't even on the table, as NVIDIA has beaten sales estimates by an average of about 3% over the past 3 quarters. For now, those prospects are distant. Chip demand is only strengthening. What's more, ARM Holdings and Intel recently said they were unable to meet all demand due to supply chain constraints. Shortage fears have Tesla and SpaceX CEO Elon Musk building a semiconductor fab to ensure enough chips for all of the AI applications he's dreaming up. The total addressable market for AI computing is bigger than anyone thinks, says Ritzis. AI agents, which are becoming ubiquitous, will add to demand, for example. And these agents, created from Gemini or another AI model, function by constantly inferencing or accessing AI computing. NVIDIA chips remain the heart of AI systems. GPUs are particularly well suited for AI computing because they can handle myriad tasks simultaneously, rather than completing them sequentially like a traditional CPU. The accelerator chips from the likes of SpaceX or Alphabet are designed to perform specific tasks with high efficiency, in addition to the computing that NVIDIA chips can handle. The entire AI computing pyramid will grow, and the base of that pyramid will remain NVIDIA. And we'll move to the cover story in Barron's, an energy roundtable, riding out the crisis. Oil and gas production won't rebound quickly, even if the Iran war ends soon. Our panelists pick 11 stocks to weather the supply shock. This is written by Avi Salzman. The world is grappling with the largest energy supply shock ever as the Iran war heads towards a fourth month. Asian countries are rationing fuel, governments are emptying their crude oil stockpiles, airlines are canceling thousands of flights, and Middle East alliances are fracturing. Barron's convened an all-star panel of energy experts on May 8th to discuss the ramifications for the global economy and investors. This year's Energy Roundtable panelists, who met on Zoom, included Lloyd Byrne, head of North American Energy Research at Jefferies, Helena Croft, head of Global Commodity Strategy at RBC Capital Markets, Seth Kirkham, Chief Investment Officer for Global Equities at Galvanize, and Dan Pickering, Founder and Chief Investment Officer of Pickering Energy Partners. Here's an edited version of the conversation, including a discussion of the panelists' favorite stocks. Barron's. Thank you, everyone, for joining us at such a fraught and busy time. Halima, you've spent many years analyzing energy production in the Middle East. What stage of the war are we in? And has the full impact been felt yet in energy prices? Halima Croft. We're in a ceasefire with no oil purgatory. We don't seem to have material movement toward reopening the Strait of Hormuz, the key energy transportation waterway from the Persian Gulf. The Trump administration is probably weighing exit strategies and mostly just planning to stay the course for a few more months in the hope it can induce Iran to make significant concessions at the negotiating table. But none of the options, negotiation, escalation, or just cutting its losses and getting out, is a path to a quick resolution of the energy bottleneck. The best case scenario, which I don't think we're close to achieving, would be some type of resolution with the Iranians whereby they agree to basically disband the Tehran toll booth and allow free access to the strait. Even then, it's going to be a protracted process to bring back oil production. Just debottlenecking the strait is going to take a couple of months. Also, the national oil companies in the region shut down oil fields. Certain countries will be faster to bring back production in a benign scenario. The Saudis will be a 3 or 4 month story. But the Iraqis have serious physical infrastructure challenges. It could be 6 months before we start seeing real recovery in Iraqi production, and that's if we get a negotiated opening now. Barron's. So why haven't oil prices risen more? Crude oil is still trading around $100 a barrel, which isn't extraordinary from a historical perspective. Croft. The White House has been exceptional at managing sentiment. It's managed sentiment from the start that this will be a short war. If you had told most market participants February 28th that we'd be talking about a multi-month disruption, with 12.5 million to 13 million barrels of crude lost on any given day, they would have had a much higher price forecast. Now the market is essentially a broken barometer. It's in no way indicating the degree of a risk to the system. When will prices reflect the truth? Croft, when we get to summer. It's going to be harder to paper over the degree of the supply shock. Right now, we're still working off the 400 million barrel strategic stockpile release. Dan, what's the view from Houston? Do you agree that we haven't seen the worst? Dan Pickering, the amount of complacency around the path we are on is way, way, way too high. What Halima laid out was months and months of continued challenges. We're going to tank bottoms on inventories if that's the case. The price implications are only going to get more obvious over time, and by the time it hits people in the face, it's going to be too late to do much about it. American energy firms have made a lot of money because of the war. Do they mostly see it as a chance to make a windfall? Or are they unsettled because of the volatility in the market and the fact that their end customers are suffering? Pickering, the unsettling piece for the folks in the industry is that we may have high enough prices that they make a lot of money, but they could have a real demand problem. We could be turning off 3 million, 5 million, or even 8 million barrels a day of demand. That will be cyclical for a while, but the risk is it could be structural. Do you want to have $80 oil for 5 years, or do you want to have $140 oil for 1 year? I think the industry would prefer duration. The challenge is that this is the train wreck you can see coming. Frankly, the price signal in the intermediate term isn't particularly dramatic. It's low 70s, high 60s oil. Nothing that's going to spur a huge amount of incremental spending activity by oil companies. So the industry is sitting on its hands. The other piece that domestic oil companies are worried about is being viewed as profiteers and becoming scapegoats for what's happening, when the reality is that they aren't getting signals from their investors, from the price, from the marketplace, or the commodity markets to really do much other than see how this plays out. Barron's, will U.S. gasoline prices go above $5 a gallon? Pickering, how does it not happen? If the globe is short 10 or 12 million barrels a day of supply, how do you not see higher prices? It's somewhat inevitable. Managing sentiment can be done for a while, but you can't manage the physical market forever. U.S. prices are somewhat insulated right now, but they're headed higher. The inevitability of what's happening seems pretty clear for folks in the energy community because of the timing of all this. If there is a solution to the war soon, then it will take time to bring supply back on. That's months. The broad market expects a light switch to be turned on. The real shock comes when you try to turn the light switch on and nothing happens. Lloyd Byrne says, I have a question. There's no pressure on the Trump administration to end the war because oil prices aren't going up, right? But if gasoline tops $5 or $6 a gallon and the 10-year Treasury yield starts moving higher, won't there be a forced resolution? Is that what this situation needs? Croft, I love this question. I don't know what the pain point for the administration would be, but how do you get out? Do you do a unilateral exit? And then do you say to countries that depend on the Strait of Hormuz, you solve this, and Iran has toll booth rights? The U.S. unilaterally leaving won't get us back to February 27th. Are we going to try to force Iran to stop controlling the Strait of Hormuz? That's what some of our regional allies are saying. Finish the job. Are we going to have a massive military deployment? Are we going to try to change the government in Iran? I don't see a fantastic set of options. Barron's, Lloyd, do you agree that the oil price is a broken barometer and the market is irrational? Byrne, I agree with Halima. I don't think the proper signals are coming to the market. Prices aren't high enough yet to hurt demand, but the back of the curve, longer-dated energy futures, just isn't high enough to incentivize a short-cycle production response. Seth Kirkham, don't we have to ask ourselves why the signals aren't materializing? It's usually wrong to stand in your ivory tower shouting out the window that a broad swath of people in the market are mistaken. In my 30 years' experience in markets, less discreetly focused on oil markets than some of the others here. That's been a dangerous tactic. My perception is that things are different this time. During the oil price shocks in the 1970s and 80s, we had limited alternatives, but still saw high-cost and geopolitically unstable energy sources getting kicked off the price curve. We used to have oil burners at power plants in the 70s and 80s. There were almost none left in developed markets 4 or 5 years after the oil price shocks. And now we have alternatives. We didn't need that price signal for Vietnam to cancel a gas-fired power station project 2 weeks after the war started and replace it with a renewable energy project. We didn't need that price signal to see significant shifts in the near-term demand for electric vehicles versus internal combustion engine vehicles. We're in a different paradigm. Perhaps we were already on the road to substantially lower long-end oil pricing. We have peak oil demand in China. China is now importing less oil sequentially year on year. In the short term, there's the risk of energy price spikes and even curtailments because of the lack of availability. But isn't this longer curve price reaction telling us something? We shouldn't assume the market is wrong. Barron's, is it telling us that the world is going to move off of fossil fuels a little faster because of this? Kirkham, precisely. Pickering, I understand what Seth is saying, but those shifts feel like they'll happen over longer periods of time, not as soon as 27 or 2028. I spend a ton of time worrying that I'm in an echo chamber and the market is smarter than me. I hear the bear case, that we're going to be swamped with supply as soon as this war ends. I just don't know that the energy substitution process will happen in the next few years. Seth, should investors in more traditional types of energy become more flexible about alternative energy investments, understanding that there is a shelf life in oil and gas? Kirkham, well, that's an inevitability. Oil and gas aren't going to go away. Most assumptions I've seen for a net zero type would assume somewhere between 20 and 50 million barrels a day of traditional energy consumption. But there are good returns on investment in shifting your choice of powertrain from internal combustion engine to batteries, and it's happening at an accelerating rate. China will consume less oil this year than last year. I remember peak oil conversations 20 years ago that never materialized. The cost curve of internal combustion engine vehicles came down. Emerging markets developed more rapidly than people expected, and the penetration of vehicles in very large markets such as India and China got to a point that people didn't expect. Now both of those markets are going in the other direction. Lloyd, when you read oil company earnings releases and listen to company conference calls, do you detect management anxiety about the company's core business models, or do you hear the same confidence as in the past? Burn. The industry is surprised by the commodity reaction to the war. I listen to what Seth is saying, and I expect the transition to alternative energy sources to accelerate globally. It will probably be faster than any focus on environmental, social, and governance factors could have achieved. And when we look at the market, we try to think about the major themes and where wealth is being transferred. It's going into artificial intelligence, into power and electrification. Themes include geopolitical conflict, reshoring, and deglobalization. A lot of opportunities are being created for some energy companies, and for others, things are changing. Companies face many questions. Do they spend more on the business? Do they return more to shareholders? The opportunities and answers will be different across all the different parts of the energy complex. Halima, how should investors think about the United Arab Emirates dropping out of OPEC? Is this the end of the Organization of the Petroleum Exporting Countries? Croft. I don't think it's the end of OPEC. People have been writing the OPEC obituary for years. Once ADNOC, the Abu Dhabi National Oil Company, made the decision to invest $150 billion in expanding spare capacity, there was a significant question mark over how long they wanted to remain in OPEC and have production restraints. Leaving OPEC was primarily a commercial decision. The UAE has been consistently producing at fairly elevated levels. It reflects the desire of the UAE to monetize that investment in spare capacity. Barron's. Well, there'll be a market share war after the war ends, with the UAE and Saudi both trying to ramp up production to high levels. Croft. Since the UAE exit, both sides have been trying to take the temperature down. Their comments have been instructive. They aren't looking to flood the market with oil. In the immediate aftermath of the war, countries are going to have to build back infrastructure. They're going to have to get their fields up and producing. So overproduction isn't an issue we'll be dealing with for some 6 months post-war. I'm not worried about a market share war on day one after the war ends. So we shouldn't be concerned about a massive oversupply after the war ends? Croft. OPEC had little spare capacity when this war began. Most of the producers except Saudi were maxed out. There wasn't a lot of production restraint. What happens next will largely be a Saudi decision. What is Saudi Arabia's appetite to manage the market? Pickering. Remember that the other dynamic that'll play out post-war is that everyone will be rebuilding their oil inventories. The U.S. Strategic Reserve was at 60% going into this conflict, and we're pulling it down from there. Around the world, reserves are going to go to full, and then maybe expand from there. For a time, people will want every barrel they can get. It'll be a while before we're worried about OPEC members having to manage the market again. Kirkham. What happens in a right tail, unexpected, event? I hate to be cynical about American politics, but President Donald Trump's goal is to get mortgage rates and energy prices down ahead of the midterm elections. And that window's getting tight. Iran is under pressure as well. It's struggling to generate hard currency right now. The risk for the Iranian government is that inflation gets out of control. They have to keep producing local currency to pay the army. So let's assume there's a right tail event where there is a solution to the Strait of Hormuz and simultaneously some sort of solution to the war in Ukraine. The short-term upper pressure on oil prices will be substantial, and it'll be necessary to bring back as much production as possible. But what does it mean for prices in 2028, 29, and 2030 if in the next 3 months both of those scenarios prevail? That supply, coming back, could actually put further downward pressure on prices. Croft. I wouldn't put high odds on that, but it's worth playing it out. If the clock starts the moment there is a deal, you have to get ships back to the Persian Gulf and figure out how to get fields operational. It becomes a logistics issue as opposed to a policy problem. Even in that perfect scenario, it will take months to resolve the issue. It would be amazing if that were the end state. But how close are we to that? And with that question, we've come to the end of our reading of Barron's Magazine for today, May 18th of 2026. This is your reader, Eric, saying be well, be safe, look after each other, and remember our veterans, especially those we've lost recently. Bye for now.